Just going to wait for the indication that the recording has started. Okay, recording has started. Sorry about that delay, everyone. So just to review for the good of the recording, this is going to be going over concepts and fundamentals rather than specific examples. We can probably address some examples on kind of a large scale during Q&A, and then we can address individual examples offline with individual agencies. All right, I think we are ready. So here we are, income eligibility determination and calculation, and we will be going until 3:30. So we have 2 hours with this. All right, our agenda for this, first we will be going over the income eligibility determination fundamentals, the available tools, documentation, sources of income, and then I'll go over just a few general reminders and takeaways when it comes to eligibility determination and income calculation. So let's jump right in. Income eligibility determination. So I already kind of addressed this in our policy changes earlier, but just to review, for program year 2022, IHCDA is making 2 somewhat small but significant changes to its income eligibility determination practices. For program year 2022, IHCDA is making, I just started repeating myself. We are moving from an eligibility model in which we use 60% of state median income for all households, regardless of size. Under the previous model, we had used 60% of the state median income until it was outpaced by 150% of federal poverty guidelines limit. Historically, this switch has usually occurred somewhere between a household size of 8 to 10. Before we made this change, our analysis of 2020 data showed that during that year, if we had made this change then, it would have significantly impacted 4 approved households. That is, there were 4 households who were in that size range where they switched to 150% of the federal poverty, and their income was such that they would have actually been rendered ineligible had we used 60% of state median income. This is just a look at what this year's numbers look like. So as you can see, for household size 1 through 8, 60% of the state median income is greater than 150% of the federal poverty guidelines. At household size of 9, the 150% of federal poverty actually just narrowly outpaces the state median income, 60%. And then, of course, it grows a little bit from there. So while we are moving forward with this change, we are also very interested in analyzing what effects this has. And in particular, we really want to know what effect it has on the overall eligibility, as opposed to just impacting matrix points. And so what we are asking everyone to do is to try to monitor your denials, specifically for households size 9 and above, and report those denials to us along with the overall household income. And that way we can determine whether this change has had a larger unintended consequence than we expected. The second change, obviously, is we are refining our definition of income eligibility period to provide greater consistency for all applicants and across subgrantees. So when determining a household's income, the eligibility period shall be defined as either the 3 most recent complete months prior to the date of application or the immediate 13 weeks preceding the date of application. The current month shall not be counted as part of the eligibility determination period if you're using the 3 most recent complete months, except in 3 very limited circumstances. So moving over a little bit, so I'm not blocking anything. The first circumstance is if the household receives only fixed income, such as Social Security administered benefits, and has already received their benefits for the month of application and can expect to receive no more income. Second circumstance is the last day of the month, which would render the current month also a complete month. And the third circumstance would be if the household's pay schedule is such that they can reasonably expect to receive no further income for the remainder of the month, and providing additional documentation to use the previous month would be burdensome for the applicant. So I know that third one in particular is a bit of a mouthful, but I think it's actually, once I go over the examples I do have here, I think it'll make sense to everyone. So here's the example. In this example is November 22nd. A household of 3 presents as 1 adult receiving SSI, 1 adult receiving wages for employment, and 1 child. The adult with employment presents a check stub for November 18th. Now there are two different situations here with that same basic scenario. If the employed adult's check stub indicates that they are paid on a 2-week pay period, then you can deduce based on that November 18th check stub that the next paycheck is going to be December 4th. The applicant further states that they no longer have access to the October 22nd pay stub. In this instance, it would be acceptable to count November as a complete month and use September, October, and November for income because their next paycheck is going to be December 4th. It's going to be out of November. In this case, they've already received all the pay that that household can reasonably expect to receive during the month of November. Rationale for using this must be noted in the case file if you're going to use this as a current month. On the other hand, if the employed adult's check stub indicates that they are paid on a 1-week pay period, then the adult will receive another paycheck on November 25th. November, therefore, is not a complete month of income. Intake must either use August, September, and October income or count 13 weeks of income from the date of application. And also, just a note, while we're talking about timelines, except in cases where the drastic loss of income policy is being used, in households with mixed income sources, the same income eligibility period must be used for the entire household. So you can't use one method for one household member and another method for another household member. It needs to be consistent throughout the household. So there are a few reasons why we're making these changes. So first, specifically with regards to the switch from using the hybrid of the greater of 60% SMI or 150% federal poverty level, that is due almost entirely to federal guidance related to the implementation of the water program. So when HHS was first releasing information to us about how we are going to implement the water program, that initial bit of guidance instructed us that we could not use kind of hybrid income thresholds. We could use 150% of federal poverty if we liked. We could use 60% of state median income, but it needed to be consistent for the entire program. And because the water program was being run with EAP and has categorical eligibility, we needed to be sure that EAP and water had the same income guidelines. And so the easy choice for us to make was to just pick one or the other for EAP. And because for most of our households are not large enough to benefit from the larger guidelines provided by the federal poverty at the larger levels, we went with 60% of state median income. Now we made that change quickly because we were trying to develop our policy manual and these trainings. Of course, after we made this change, the federal government did release additional guidance that basically would have allowed us to continue to do the 150% federal poverty guidelines in cases where that was larger. But at that point, we had already made a lot of the changes, and it seemed like it was going to be overly burdensome to go back and change things back. So we decided to just move forward with it this year. Like I said, we are very interested in analyzing how that affects things. So please do communicate that with us. Second, simplicity and streamlining. When we are trying to explain the guidelines to any federal or state partners, to any community partners, to applicants themselves, it's easier when there's only one kind of standard that we're using. If we say, well, we use this standard until this point, and then we switch to a different standard, it becomes a lot more murky. And so it really simplifies and streamlines our policy. As far as changing the income period and eliminating the use of the current month as the third month, that mostly has to do with increasing consistency across the state and just equity of our income determination policies across the state. So under the previous policy, there definitely were loopholes where any of the agencies who were using the current month as the third month would automatically grant a huge additional kind of leg up to anyone who applied early in the month versus late in the month. So under the way the previous policy was written, it could be conceivable that someone who had just been paid on October 31st could conceivably apply on November 2nd. And if that agency that they applied at had the policy that said that they count the current month as the third month, that would look like November was a month of zero income. So it would basically take. We have seen cases where similar to that scenario, an applicant might have September and October income counted, have November count as $0, even though it's only 2 days into November, and they would essentially have 2 months of income counted as 3. I think we do want to obviously increase access to the program, and we want to give as much benefit as we can to people when they qualify for it. But it really seemed to me to be kind of an artificial way of expanding that, and it wasn't really equitable across the state. So we just really wanted to bring things more standardized and be sure that everyone can expect the same thing. Our ultimate goal here, to be completely transparent with everyone, is we're trying to bring things slowly over time, but more to a point where anyone in the state can apply anywhere and reasonably expect that their income will be calculated in the same way. It's never a good look when people in different parts of the state can step into any one of 21 different agencies, and I know I'm exaggerating a little bit here, but have 21 different answers on what their income is, what their eligibility is, what's available to them. So we're just trying to bring a little bit more consistency and equity there. We are trying to make tools available to you to facilitate and reduce the burden of income calculation. And we do strongly encourage all subgrantees to train their intake to the use of these tools. So these tools include Excel workbooks of incomes calculation spreadsheets. These workbooks have been developed and are maintained by some of your peers who are on this very call. And they put a lot of work into them. Elaine and I believe Lisa Castle helped to develop these, and I know last year I worked pretty closely with Elaine in helping her get these updated. She does put a lot of work into them, and they're a really great tool. EAP Connect does have an onboard calculator, and For those of you who remember from the roundtable, we are working on a pilot spreadsheet for the 13-week employment income calculator. I know that I have a list of agencies who have expressed an interest in piloting this program and looking at the spreadsheet. I apologize, I have not gotten that out to you yet. That will be coming out soon. It's kind of on my radar for next week after we finalize these trainings and I get the state plan submitted. That's kind of my next big project. And I do want to share that in addition to the EAP Connect onboard calculator, once I get that pilot spreadsheet fixed, there are a couple of issues in it that still need to be tweaked. And I think I figured it out in the process of making this presentation when I kind of wrote out the process of what those calculations look like. But I am also working with Brad to get the 13-week method programmed into the EAP Connect onboard calculator. So the ultimate goal is that you'll be able to just punch in the pieces of data that are required and EAP Connect can make that 13-week calculation for you. Easy peasy, lemon squeezy, as they say. And our ultimate goal here, and my goal with teaching this module in terms of fundamentals and concepts instead of examples, is that we want subgrantees to feel confident in their income calculations and the accuracy of their benefit determinations. And our philosophy is that if you're confident in your income calculations and your benefit determinations, and you are able to use the concepts and guidelines that we're giving here, that should ultimately reduce or eliminate monitoring findings based on income calculation. That's ultimately what we want. We want to get as much benefit as possible to people who qualify for it without having paybacks. And as always, we do welcome feedback and suggestions. So some of the benefits of using income calculation spreadsheets and other tools for calculating income, including eliminating mathematical errors, providing a clear picture of how income is calculated. It really simplifies the process of double checking to verify that income is entered correctly. It does show the monitor, Renee, how the calculations were figured. And ultimately, as I just said, to reduce errors in how crisis is calculated. Well, that specifically talks about crisis also, but. All right, moving on to documentation. So first things first, because we just talked about how the spreadsheets will help the monitor to know how the income was calculated, how a specific answer was arrived at. If an intake uses an Excel spreadsheet to calculate income, then that spreadsheet should absolutely be scanned or saved and uploaded into the client file in order to show that calculation. In most cases, the manual lists acceptable forms of income for different income sources, usually in order of preference. As a general reminder, whenever a less preferred form of documentation is accepted, intake should note that in the applicant file. And also indicate why more preferred forms of documentation were unavailable. And income verification affidavits should only be accepted as a last resort for any otherwise documentable forms of income. For employment income, for example, a request for earnings should be attempted before accepting an income verification affidavit. Income is always calculated based on the date of application and not the date of application processing. This is important to note for your eligibility determination period. For instance, if an application is received on December 13th, but not processed on February 1st, the income eligibility period will be determined based on that application date of December 13th, not February 1st. As long as income documentation is current as of that date of application, then intake should be using that documentation submitted as part of the application rather than requesting updated information. So let's take, for example, the situation that I just mentioned in that first bullet point of an application received on December 13th and processed on February 1st. So if the applicant submitted a 2-week pay stub dated December 3rd, then the intake should not request a pay stub for January 28th, since December 3rd would have been the current pay stub as of December 13th, which was the actual application date. However, if the applicant turned in a pay stub for November 5th, then the intake may request a more current pay stub or seek clarification that November 5th was the applicant's final pay with that employer. All right, let's talk about sources of income. So we have, I'm probably going to rattle off this list because I've been rattling this list off for about 10 years now. Wages, salary, tips, bonuses, commissions, self-employment, profits from business, military allotments, excluding combat zone pay, disability payments from insurance, Social Security, SSI, railroad retirement, and railroad disability benefits, Black Lung survivor benefits, income from rental property, life insurance payments, dividends, interest, gamblings, winnings, awards, pensions and annuities, retirement plans, royalties, strike benefits, unemployment benefits, veterans benefits, regular life insurance payments, workers' compensation, alimony payments, irregular income, odd jobs, household support, and of course, a partridge in a pear tree. This represents just about, I think, all of the major forms of countable income. For the most part, anything that falls outside of what I just listed here is usually going to be income that is excluded. In this training, we are not necessarily going to be going over the income exclusions. I think those are documented pretty well in the manual. And of course, Sam and I are always happy to field questions from you on that if you have any specific questions over whether something falls into that income exclusion category or whether it should be counted. As far as the rest of this training, we are not going to go through every single one of these sources of income. For one thing, a lot of them are super, super rare to the point where there are a few of them that I don't think I've ever seen either in my current role or even previously as EAP manager or intake at SCAP. And some of them are just very, I think they're outlined very well in the manual. They're pretty self-explanatory, or they fall in line with something else that we are going over. So first things first, just start things off easy, fixed income sources. So for federally administered benefits, such as Social Security disability, supplemental security income, railroad retirement, VA benefits, all that kind of thing. You may take the current monthly amount and multiply by 3 in order to determine eligibility income. That's it. That's all you have to do. There is one exception. So if in January and February, if an applicant presents a letter showing their 2021 monthly benefit as well as the 2022 benefit with a COLA increase, then intake should take care to apply the COLA rate to the appropriate months. Now, that is only if they provide a letter that spells out, here's what you're going to get per month in 2021, here's what you're going to get per month in 2022. If it tells you what the percentage of the increase is, we don't want intake to have to be burdened with calculating what that increase was. So if it's a case where it gives one figure and then says there was an increase of, X percent, just take whatever figure is there and multiply it by 3. Let's there are enough nuances that do complicate things. Let's keep it simple where we can. And just a good reminder for federally administered benefits only, intake should use the net amount after any withholdings and deductions rather than the gross benefit amount. For non-federally administered benefits of fixed income, and examples of this might be pension or recurring payment retirement plans. Once again, you may take current monthly amount and multiply by 3 to determine that eligibility income. Typically, your pension and your retirement plans are usually a fixed amount per month. Usually, there's not a COLA there, so you don't need to worry about that. But one thing to note is that our state plan does state that we consider the gross amount of this income rather than the net, and therefore intake should request a copy of the benefit award letter or a physical check stub showing the full benefit amount prior to withholdings or deductions rather than a bank statement showing the net amount. Unemployment benefits. So unemployment benefits may be documented via a last known employer report obtained by the LSP from the Department of Workforce Development, or via an applicant's printout of their benefit status from the uplink interface. Now, it's important to note, because I have seen this a lot, if the applicant provides an uplink report, we are going to require the full report with payment details. If they just take a screenshot on their phone of their current status, that's not going to be sufficient. The full state-provided benefit must be considered along with any federal supplemental benefits. And the amount for each week may be calculated by considering the gross paid plus the total withholdings. And basically, that's in normal times, that would be equal to, I want to say the entitlement is the column that would usually be equal to. However, because we live in anything but normal times, there is the matter of the federal pandemic unemployment benefit, and that typically has not been reported in any column other than gross paid. But of course, gross paid already takes out those withholdings. So that's why, unfortunately, you do have to take the gross paid and add in the total withholdings column. And when you're looking at the date of the payment, you are going to want to look at the process date, not the claim date, because basically because a lot of times these claims are kind of denied at first and then get approved in arrears. And so you just want to be sure that you're looking at when they actually received this payment. All right, self-employment. There have been a couple of very small changes to self-employment. I did make the decision not to include any screenshots of the actual schedules in here because I feel like that backfires on us every time I do that, because by the time the 1040 form gets released for the next tax filing season, usually those schedules have changed and everything that I've prepared for you guys ends up being useless. So I am trying to get ahead of that and just tell you what you're looking for. And once the new 1040s and schedules are released, I will review them and see if anything has changed and issue guidance accordingly. So self-employment can include things such as profit or loss from a business, rental income, royalties, partnerships, S corporations, estates, trusts, farming, or church employee income. Because of the nature of self-employment income, it is calculated based on the most recent complete tax year. So if someone were to apply in November, you would be looking at their 2020 taxes, which would have been filed by, I think this year, the tax year had been extended until like May 16th, I think, of 2021. So you'll be looking at some quite old income. So the income for the full year is divided by 4 in order to determine representative 3-month income. If the applicant's self-employment income had not been present during the previous tax year, if it's a business that they just started during the past year, then intake should attempt to obtain 3 months worth of receipts accompanied by an income verification affidavit. And ultimately, we can provide guidance on that if anyone finds themselves in that situation. My hunch would be that there weren't a whole lot of sole proprietorship businesses that were started during this past year, but I could be wrong. But ultimately, we're going to want to see whatever documentation we can get to make sure that the numbers report on the IVA makes sense. But my ultimate guidance would most likely be, as long as it looks like everything makes sense, to just take the numbers from the IVA rather than trying to, enter all these receipts into EAP Connect. If the applicant does not file taxes for the self-employment income, then this income is going to be considered irregular or incidental income and not true self-employment. In order for it to be true self-employment, because this is part of our federal reporting, we want to be sure it's legitimate self-employment, that that its taxes are filed on it and paid on it, and they're registered as a business entity. It's just important for our CSBG and other federal reporting. So to properly document true self-employment income, the applicant must submit their entire previous year Form 1040 tax return, including any applicable self-employment schedules. And so here's the breakdown of the specific schedules that we are interested in looking at in order to calculate this income. So the first thing you're likely to see is Schedule 1, which is additional income and adjustments to income form. And Schedule 1 isn't actually going to give you any of this income information, but it will summarize what kind of income is included in the return, and it should indicate to you what other schedules you should be seeing. So if you see a Schedule 1 that indicates that there's both profit and loss from a business and supplemental income and loss, but you only have a Schedule E and not a Schedule C, you know that you have an incomplete tax return there, and you need to request that Schedule C. Speaking of which, Schedule C is probably the most common schedule that you'll see in here, other than the Schedule 1, and that is profit or loss from a business. As mentioned earlier in our first module, we are going to be using line 5, gross profit. That is distinct from last year when we used line 7, which was gross income. When I looked at the difference between line 5 and line 7 this year in trying to re-examine our policies, I noticed that what was included in line 6, which is what made the difference between gross profit and gross income, were a lot of kind of tax credits and things that typically are excluded as income. And so it seemed to me that we were really kind of doing a disservice to our self-employed individuals by creating sort of a double standard there, where we were maybe counting some income against them that would not have counted against anyone else. For those of you who have been around for a little bit, you'll remember that a few years ago, we went from AGI to using the gross income because the AGI had all kinds of allowable business deductions for things that really made it inequitable toward people who weren't self-employed. Things that we never would have allowed self-employed or non-self-employed people to deduct from their pay, we were actually allowing self-employed people to deduct from their income. So we made a correction, and in analyzing this year, I realized that we did make an overcorrection. So I'm trying to walk that back a bit and make it somewhat more equitable. So that's why we went from using line 7 to line 5. And that is the only line we're going to look at on Schedule C. On Schedule E, so Schedule E is supplemental income and loss, and Schedule E has all kinds of different supplemental income. So that's why there's so many sub bullets here. So line 3, rents received, that's for I know Hannah had the question last session about landlords who apply. So line 3 is where they would record and claim any rent received through the course of the tax year. So for anyone who owns property and rents it out, line 3 on Schedule E is where you're going to find that income. Line 4 would be royalties received. Don't see a whole lot of that. I think I've maybe seen it once in the past 9 or 10 years or so. Partnership and S corporations. I know that we do see S corporations from time to time. And I think last year I did get a specific question from the network because I had neglected to address this in the manual. So I want to make sure to correct that this year. So for partnerships and S corporations, you're going to use line 32 on Schedule E, and that's the total partnership and S corporation income or loss. Estates and trusts, you're going to use line 37, total estate and trust income or loss. Real estate mortgage investment conduits. I have no idea what that is, so please don't ask me, but you are going to use line 39 to document that. And for farm rental income or loss, you're going to use line 40. Now that is farm rental, so that is distinct from profit or loss from farming, which is documented on Schedule F. If you have a Schedule F, it's very straightforward. You're just going to use line 9, gross income. I'll have to double check, but I'm pretty sure that line 9 does not have the same issues that line 7 on the Schedule C had. But I will double check that when I get back into the office on Thursday. And finally, there may be cases in which you see a Schedule SE, self-employment tax. Now, the Schedule SE is not going to, it's exactly what it says. It documents the tax paid by self-employed people. So for the most part, it's not going to show income, but there is one little tick on it where if there's something on line 5A, that is actually the only line on the Form 1040, as far as I'm aware, where church employees would record their income. So if there's a long Schedule SE and there's an entry in 5A, that is going to be recorded as income. Clear as mud, right? I wanted to be sure that this information was presented in a very straightforward bullet list format for everyone, just to make it easy to reference. So as mentioned, on Schedule C, we are now using line 5, gross profit, instead of line 7, gross income. For those who are really paying close attention and thinking about our former processes, you will also notice that what I did not mention is anything about a utility deduction on that Schedule C. That is because we are now no longer going to add the value of any claimed utility deduction to the income, regardless of where the business is run. So even if they're running a business out their home address and they claim a utility deduction on their taxes, we are not going to count that against them. It's when I thought about it, you know, when we went from AGI to taking the gross income, we did away with giving any allowances for those deductions. And it just seemed really inequitable to then count against a household a utility deduction that's already accounted for essentially in the income that we're taking. So we did away with that this year. And just one other note on self-employment, if the applicant's self-employment income is 0 or a negative, if they have a loss, then that income becomes recorded as 0. We are not going to enter a negative amount for the household income. And also, if someone did experience a loss or shows zero gross income for their self-employment, then they are not going to have to follow the procedures established for zero income applicants. You're not going to have to send off for DWD for the last known employer report. We can just take them at their word, essentially, because they've already signed a tax return with the IRS, who is far more aggressively litigious than we are. And so if they are feeling confident enough that they can sign a form to the IRS stating that that they had that 0 income, we don't have to double check them on that. Employment, salary and wages. So Subgrantees are not to use a last known employer report to identify or determine employment history or income. Employment income may be calculated using a pay stub or pay statement, a request for earnings statement, or if neither of these methods are feasible, an income verification affidavit. Should be noted, because we are redefining the income eligibility period, W-2s are, in general, usually not going to reflect the time period we are going to catch in the eligibility determination. And to be honest, the W-2s, in my mind, kind of stopped being nearly as useful as they were once we moved to the 3-month income from the full 12-month income. So due to these changes, W-2s are no longer considered a preferred document for employment income. This is obviously a change. It's going to be something that some of our longtime applicants are going to have to get used to. But the simple fact of the matter is, as I just alluded to, ever since we moved to 3 months, there used to be a real burden reduction benefit in using a W-2 for intake, because intake could just take that 12-month income and just plug it in. But we really, especially with the fact that we're going to be looking at income from potentially an entire year before, we want to be more current with our income. We want to be sure we're getting their current rates. We also don't want to count against them if it's a job that, you know, for instance, they might not work at any longer, or they might have stopped working there since January, but they're still submitting a W-2 for the entire previous year. We don't want to count that income against them if it's not current income. So we just want to be sure that we are capturing the best possible and most current information that we can. So to get a little bit more into what we were talking about earlier, to calculate income via the 3 most recent complete months. So you're going to take the year-to-date gross income from the end of the most recent complete month. If it's available, use federal taxable gross income. However, if the check stub does not identify federal taxable gross amount, then the intake may not calculate this amount on their own. So federal taxable gross, if it's there explicitly, great, use that. If it's not there explicitly, then you're just going to use that year-to-date gross without calculating what constitutes federal taxable gross on your own, you know, which usually involves certain pre-tax deductions, including health insurance and things like that. We're not necessarily always going to know how these things are deducted from someone's paycheck, unless it's spelled out as a federal taxable gross amount. And also, we're trying to streamline and simplify the process for intake, so we don't want them to do unnecessary calculations. It is a little bit of an inequity in that everyone has, for the most part, a difference between federal taxable gross income and their regular gross income. But some payroll vendors, some payroll providers don't report that until the W-2. So it is unfortunately putting someone at the mercy of whatever their employer's payroll vendor provides. But that's something that is outside of our control, and we really don't want the burden or the potential of the greatly increased potential of human error that comes with calculating this on our own. So once you have that information, you're going to identify how many months are represented by the pay stub. In general, this will usually correspond to the month of the pay stub. For instance, November would be month 11. So that would be 11 months on that pay stub if you have that end of November pay stub. If the applicant discloses that they began to work after the beginning of the year, you will need to subtract any months for which no pay was received. That is, if the applicant received their first paycheck in March, then that means that that pay stub does not represent January or February at all, and they should be excluded. So January and February, those are 2 months. You're going to subtract that from the 11 months because November is the 11th month, and that means that that pay stub actually represents 9 months in that case. Once you determine how many months of pay are in the check, divide that year-to-date federal taxable gross, or year-to-date gross if that's all that's available, by the number of months represented in the year-to-date in order to determine the representative monthly rate. So in that previous example, say it's a November pay stub and they didn't get their first pay until March, you would divide that year-to-date gross by 9. Once you have that representative monthly rate, you're going to multiply it by 3, and that will determine the employment income for the eligibility determination period. Unless, if the applicant is no longer working and more than a month has passed since their last pay date, then you may need to adjust the number of months you multiply by to account for 0 income months. So what that means is the applicant stopped working in October and received 0 income for November and applies in December. You will then only use 2 months of wages, September and October, and 1 month of 0 income, November. So in that case, instead of multiplying that monthly rate by 3, you're going to multiply the monthly rate by 2. And of course, document that via an IVA, preferably, that the applicant had 0 income for the month of November. Now, I am going to go over the 13-week method. I'm going to go through this first rather than prefacing it. So to calculate income using the 13-week method, you're going to use the most recent available pay stub. Take note of whether the pay period represents 1 week or 2 weeks. This has not yet been, I've not yet figured out how to apply this to people who receive 2 pays a month on a fixed day. That is quite an uncommon practice, but it is something that I know that Renee sees at least a few times a year. So that's something that still needs to be addressed. And I'm working on that. But for now, let's just assume it's a fixed every week on the same day of the week or every 2 weeks on the same day of the week. So you're going to determine the week number out of 52 weeks represented by that pay date on the check. Then furthermore, if the pay period is a 2-week pay period instead of a 1 week, if you have an odd number there, you're actually going to round it up to the next even number. So for instance, if it is January 22nd, week 3, you would actually count that as 4 because since it's a 2-week pay period, there's always going to be an even number of weeks. It needs to be divisible by 2 because there's going to be 2 weeks on each check. If the applicant started working after the beginning of the calendar year, then you would need to try to determine when the first pay occurred. Determine the week number of this pay date, and then subtract 1, and then subtract that number from the pay date week number. You would then take that number and divide it into the year-to-date federal taxable gross or year-to-date gross if that's all that's available, which will give you the representative weekly pay amount. You would then take that number, multiply it by 13. That will give you eligibility determination period income. But of course, you then have the situation in which maybe the applicant is no longer working at the job. So you'll need to determine how many weeks have passed since their last pay, and then adjust that multiplier of 13 accordingly. For instance, if the last pay was 4 weeks prior to application date, then you would multiply the representative weekly amount by 9 instead of 13, and then count 4 weeks as 0 income. I know I know very well, especially because I just had to type out all these instructions the other day. This is a very complicated and unwieldy process for an intake staff to calculate by hand. It also greatly, greatly increases the potential for human error, which is exactly what we're trying to avoid. And so this is why we have developed and are tweaking a spreadsheet in order to automate this calculation with some simple data entry. And we are working with Rowing to have this incorporated into EAP Connect. The end result of this will be that essentially we have a spreadsheet that we've already started that includes drop-down menus, yes/no options, entering the date of the check, date of the application, if the person is no longer working, when was their last pay, if they did not begin at the beginning of the, if they did not start working at the beginning of the year, about when was their first pay. And it takes all this information and it's going to do all the work for you. Essentially, once we've finished fixing the few problems that remain with it, you'll be able to enter raw data and get both the representative weekly amount plus the final 13-week income period income. So that's what I'm working on for you. And again, this is in a pilot this year, and subgrantees may choose whether or not they wish to opt in for piloting this income calculation method. Any subgrantee who does choose to pilot will have opportunities to provide feedback on the spreadsheet and on the general effect on intake and applicants in terms of whether it makes more or less burden for them. And will kind of be able to help give us guidance as we make decisions on what the future of this policy is. You know, as I said, I'm trying to standardize things across the state. I'm trying to make things a little bit more transparent and make sure that everyone is kind of being treated equitably and can reasonably expect that their application would be processed and calculated the same way, no matter where they live, what agency they apply with. This might not work. This might blow up, but it's something that I did put a lot of thought into. Had some discussions with the team. I think it's worth pursuing, and you know, I really think that the logic underlying it stands up to scrutiny. So feel free to, I know I do have a list of people who have already volunteered to pilot it after the roundtables. Here's kind of a last chance for people to express any desire to opt in for this. All right, next up on documentation, request for earnings statement. So the request for earnings statement is a form that may be used to get wage information directly from an employer when an applicant is unable to provide pay stubs. It may also be helpful for applicants who are involved in gig work and have no concise report of aggregate earnings. Notice I did say it may be helpful in those cases. It may very well not. I just have bad memories of processing applicants who came in with like a ream of reports from driving Uber or Lyft and trying to figure out what the actual income was there. So I'm hoping that can help in those cases. Because of the potential for falsification with this form, it is advised, strongly advised, that LSPs obtain the applicant's release signature on the form and then contact the employer directly in order to send them the form, rather than providing the signed form to the applicant and having them give it to their employer. Just because we have no way of knowing if the employer actually filled out that information. We also have the income verification affidavit, of course. The income verification affidavit allows applicants to declare any irregular or incidental income, to declare zero income for any month or for all 3 months of the eligibility determination period, or as a last resort to declare employment income for which they have no other documentation, and documented attempts to obtain pay stubs or a request for earnings statement have failed. Do note that we are required to use gross income for employment and not net. Therefore, if you do have someone who has been unable to obtain pay stubs or request for earnings statement, your best practice would be to, in addition to taking that IVA, to verify an applicant's pay rate and average number of hours worked per week, and that can just be a verbal clarification. Make sure you document it and ensure that those figures kind of jibe with what they've provided as their monthly income on that IVA. If an applicant declares zero income for any of the prior 3 months on that IVA, then the applicant must complete Section 3, in which they explain how they have met these financial needs while they have had zero income. If they have declined to answer these questions, then the IVA is incomplete and invalid. And at the very least, you should be contacting that applicant and asking them for that information. If an applicant discloses in Section 3 that they have received cash payments for household support and that those cash payments have been made directly to them rather than to, say, their utility company, their landlord, whatever, then that should be counted as household income if it is passed through them. I know that sometimes applicants will indicate that they received support from SNAP, and they'll list that as how they've met their food expenses. Obviously, that's not a cash payment. We are not going to count that as income. SNAP is an excludable source of income. And I did include our old slide here of what the IVA is, what the applicant needs to fill in. As you can see here, I did put where the applicant states that they receive $200 a month paid directly to them for help with their rent or mortgage. So in that case, that $200 would be counted as income. However, they also received help from their parents for utilities, but was paid directly to the utility. And so we are not going to count that as income. Same thing with the other household expenses. In this case, their parents bought things for them directly and did not give them the cash to buy things. It doesn't matter that they don't know what the value of that was. Since they did not receive cash directly, we're not so interested in that amount. We're just interested in knowing that they had some way of meeting those needs. We've documented how they've met those needs, and we have verified that since they are signing off on a legal document that they did not actually receive the cash for it, that the parents just bought them the items, we do not have to count it as income. We're not playing gotcha. We're just trying to make sure that we're documenting everything fully. General tips and reminders. So I just want to include a few things that might be helpful to remember as we move forward with income documentation and calculation. So it may help to chart the eligibility determination period for a particular file based on the application date and visualize the months that are being counted. And that might especially help if the household members have worked multiple jobs during the past 3 months. Sometimes just kind of saying, okay, here's the dates we're looking at, here's when they worked this job, here's where they worked this job, and kind of almost making it as a chart or a puzzle might help to visualize that. When looking at a bank statement, recurring payments are often marked PPD. So if you see that PPD, chances are that's going to be either it's a biweekly paycheck, it might be a monthly benefit amount, it might be a monthly pension. But it helps to be a visual cue that, hey, that's a recurring payment. So I want to be sure to clarify that, and maybe I need to count that 3 times instead of 1 time. By that same token, if you're looking on someone's bank statement, if someone turns in a bank statement for, say, their Social Security income, and you see a bunch of refunds, whether those are refunds from store returns or bank fees are being refunded to them, refunds are never counted as income. All it's doing is reimbursing something that they have already paid out. So they're not actually making income from that. So please do not count those if you see them. And if it clearly says it's a refund, you don't have to question it either. But that being said, if there are unexplained deposits on a bank statement that don't look like they're refunds and they don't look like they don't look like they're refunds, they don't look like they're transfers from, say, their savings account, and they don't match with any of their declared sources of income, an intake worker should ask the applicant about them. Basically, if they're in the documentation, they're fair game and they're subject to monitoring, and we are responsible in case it gets pulled by the feds for monitoring. We're responsible to be able to answer for those. So we just want to make sure that we are dotting all our I's and crossing all our T's in that regard. Applicants may not redact or alter their income documentation, especially on bank statements. I've seen bank statements where applicants try to redact everything that's not their Social Security income. Again, it comes back to the fact that these are federal funds and we are subject to monitoring. You know, if they are applying for federal funds, they need to comply with all the requirements, which mean that we need to be able to see the income. And we can't necessarily take their word for it that what they're redacting is not income. I know that they can be a touchy subject with some applicants, and we just need to assure them that we have privacy and confidentiality policies and procedures in place. Remember that individual income amounts under $1 do not need to be counted. For instance, monthly or quarterly interest earned on most applicants' bank accounts will usually be under $1 and can most likely just be disregarded. We want to be sure that we're not adding additional burden of having to catch every little thing. So we made that threshold the same as the threshold for rent, for utilities and rent. Try to simplify things wherever you can. As I said earlier, I know that there are enough things in here that really are nuanced and complicated. So wherever we can, let's simplify things. If you have a pay stub where the year-to-date gross is equal to the current pay, then what you can automatically deduce from that is you know that is absolutely their first pay stub at a new job. You don't need to do any math on that. You just count that income. Likewise, if you know that someone just started their job within the past 3 months, then just document that in the case notes, and then you can count that entire pay stub as income without doing any math, because it could not possibly count for more than 3 months if they just started. Remember, in general, the only reason to request a last known employer report from DWD is for an applicant who is claiming unemployment income. However, that being said, if you have reason to believe that an applicant is being deceptive, non-compliant, or potentially fraudulent, you do have the right to request this report as part of your investigation, to kind of piggyback on our previous presentation on fraud, waste, and abuse. And just to temper that, remember that we really aren't detectives. And while we do have a responsibility to be cognizant of fraud, waste, and abuse, remember that most clients are not trying to defraud the government. Most noncompliance as Dave said, stems from applicants not understanding the requirements or not realizing that they need to claim certain pieces of income. Just be open, transparent, and communicative with the client, and be ready to educate them and give second chances if need be. You know, we want to be good stewards of funds, but we don't want to be standoffish. We don't want to come off as unsympathetic. It can be a line to walk sometimes. But there is a middle ground, and I think that middle ground is where you're aware and cognizant, but also empathetic and ready to be forgiving is probably the best place for us to strive to be in situations like that. And I know that we are way ahead of time, but I also know that the income calculation training tends to be where a lot of the questions are asked, and we usually kind of cut you guys short on that, and I wanted to be sure that wasn't the case this year. So that's why I gave us the full 2 hours and created this slideshow, knowing that wasn't going to take a full hour, so that we can kind of have more of an interactive conversation around things before we head into the formal Q&A at 3:30. So this, I believe, is the last slide, but the takeaways: income calculation, admittedly, is a little bit of an art and a little bit of a science. And what we're trying to do is we're trying to tip the scales just a little bit back into the scale and into the territory of science, and take away some of that ambiguity. We do think that taking away that ambiguity will really make things better, both for intake and for applicants. And then remember, as a rule, income calculation can only be, at best, as good as the supporting documentation that is used for the determination. That is why the use of less preferred forms of documentation must be noted. All right. So let me. All right, I just threw a whole lot of information at you in, what was that, about an hour and 15 minutes, without a whole lot of details and examples. Elaine, I see you with your hand. I also see a lot here in the chat. So
do you want me to help you out a little bit, Tom?
That would be awesome, Renee.
Okay, gotcha. So the first question basically was from Pam. I'm trying to get to it. And I think she was basically asking about the effect of going from the 60% or having just only the 60%. And she's wanting to know of the SMI, how many households that's affecting. And I think you kind of answered that question, going basis off of program year 2020. And you stated that at that point in time, it only affected 4 households.
Correct. So we are, like I said, we would like any of those large households, 9 or above. 9 is the tipping point this year, that are denied specifically for income, for being over income. We would definitely like to see those reported to us so that we can analyze whether this is having a larger impact than we expect it to. But we are hoping to see similar numbers this year. Hoping to see. We're hoping not to see any more than that. Obviously, we don't want to see anyone be denied, but unfortunately, that's kind of the nature of a program like this and of having to make changes like this.
Okay, so the next question is from Cindy Balday, and Cindy, I may need you to clarify this a little bit more. She says, is the income guidelines in the manual we have right are the correct one we are taking this year? So I know that the income guidelines have been updated in the manual. So, and it does talk about both methods within the manual. So I hope that is what you're asking, Cindy. If not, if you could just clarify for me, are you still on?
Yeah, I'm on. I was wanting to make sure that this was the correct income guidelines that was in the manual.
Okay, yeah.
Okay, thank you.
You're welcome.
Unless I really messed up, they should be the same.
Okay. Well, I was just a little confused when you're talking about 150% and then 60%. I'm like, well, wait a minute. I just want to make sure.
Yeah, I was just discussing the change. That's all. But yeah,
okay.
we're straight 60% SMI for everyone this year.
Okay. All right. Thank you.
Thank you.
And then Pam Brookshire asked, so are you saying we have to get paid stubs? For each month we count. We can't just take the last paycheck stub received. Once again, I think this question was answered. It does depend on which method you use. If you are using the last 3 complete months, you would need to get the one that was for the last paycheck stub that was received. So if you have an application in the month of October 12th, you received that check stub, you will still need to get the documentation for September, if they were paid on September 30th, as an example.
Yeah, I think that was probably one that was asked before I got quite to that point.
So.
Pam's good at anticipating where I'm going to go.
Okay, so Hannah is asking, is there a new sheet this year for calculating child support payments that are not deducted from a paycheck stub? For example, it's paid directly to the courthouse with the receipt taken out of fixed income recipients' bank account, etc. Last year, they used printable calculator sheets to show work, and that was not, as there was not a worksheet available, but it was a frustrating process.
Okay. I think that's something that I can kind of consult with Elaine on and see if that's something we can put together. But otherwise, what I might suggest, what I used to at SCAP, if I recall correctly, it's been a couple years. I think what I used to have my intake do was, that would be the one situation where we'd actually put a negative income amount into the database. So essentially we put a, say they were paying $100 a month, we would actually put in negative $100 of income for those 3 months. And that would actually, it would be the easiest way of not having to do actual math, but still accounting for that child support. But yeah, I can definitely kind of talk with Elaine and see about having an actual spreadsheet for that. See if that might be doable.
And then Elaine is requesting clarification. If a letter is given with 2 amounts, regardless when the letter is received, we split according to the app date. Correct? That's correct.
That is correct. Yes. So if they receive the letter in December and it says what's going to increase to in January, but they apply in December, just you're going to be looking at October, November, December most likely, because since it's fixed income, you can count the current month as that month. So you would just use the old amount. You wouldn't use the COLA amount at all.
There was a question about what COLA meant. Pam provided the answer: cost of living adjustment. Carla is asking, what if the applicant did not include their self-employment income on their tax return in 2020? And I think you touched on this one a little bit as well. So if there is not any self-employment income included on their tax return in 2020, then they have to present receipts or some type of documentation showing their income for the previous 3 months.
Correct. That is on page, which I know I haven't sent this out to you guys yet. I'll probably send it out after the Q&A today. But that will be on page 17 of the slide deck. If the applicant's self-employment income was not present during the previous tax year, intake should attempt to obtain 3 months of receipts accompanied by an IVA.
And then Brad asked on unemployment income, the DWD report shows entitlement as well as the net being the same amount. Should we use the net? Excuse me. Also, process date is different than week ending date. You still want to use process date. Payment is usually the day after process date, if not in a denial status. So for this one, you know, the manual does state that you need to use the net amount. The only time that you would not use that net amount is if there's any federal funding or federal payout that's provided to the applicant that is not illustrated within the net, and usually that's going to be found in the gross amount. So if you do that, then you just want to add those deductions back in that you would see to get that total amount. But you do want to use the process date. The process date is the closest that you can get to the date that is paid out. Sometimes the process date and the pay date is the same. Sometimes it isn't, but you definitely do not want to use the weekend amount. Angela Lambert said you presented the best explanation of self-employment. Thank you.
Thanks, Angela.
Pam, but we could only take this. I think this is when you were using your example for income. But when we could only take November if they presented a November paycheck for the end of the month. If they apply early in November, we have to use the last paycheck check in October. We can't just use the last paycheck stub based on your previous statements.
Right. Yeah. So as long as the household can no longer reasonably expect to receive any further income for the month. So I think the example that I gave was a November 22nd pay stub. So if someone is on a 2-week pay period, that next pay isn't going to be till December. So that November 22nd pay stub would be the last pay of the month. However, if they're on a 1-week pay period, they will receive another pay on November 29th. So in that case, you would need the last pay stub from October because you can't count November as a full month. The exception being if you're going by the 13 weeks pilot, in which case you can essentially use any pay stub because of the way we're structuring that spreadsheet.
Okay, so just to clarify that though, if you use any paycheck stub, it should be the most current one, correct?
Correct. Yeah.
Okay.
Yeah. We always want the most current pay stub. Yeah.
Okay. So Elaine stated, so if the app is received in November with the current November pay stub being submitted, and they've been there all year, we can divide by 11 instead of asking them for the last October pay stub, correct? So Elaine, that is going to depend on when the application is submitted. So are you talking in terms of the full complete 3 months or the 13 weeks?
Oops. Whoops.
There you go.
I was actually, my biggest concern is we have clients who submit a pay stub, and I like to use the last 3 complete months. So that way I can steer clear of the 13 weeks, because I know that that has been a struggle, but I do believe that with the forthcoming spreadsheet, that may be helpful in the process. But I just want to be sure that I'm not having to ask these clients for additional documentation when they've submitted that application and a pay stub. Do I have to track that other pay stub back? That's what I'm worried about, because that's going to be a lot of back work, back and forth with the client when they've already submitted us a current pay stub.
Yeah, I hear that concern, Elaine, and that's, you know, I definitely am trying to design some of these changes in a way that will hopefully reduce that burden on the client. And I think this is something else that we can possibly address through something in the workbooks. But I actually have a solution that will work, I think, 8 months out of the year. So there are 4 months where this solution would not work. But basically so if someone turns in a pay stub, if you're using the 3 complete months model, and someone turns in a pay stub that is not the last pay stub of the previous complete month, it's from the next month and it's in the middle of the month. As long as it's not, and oh, this also gets blown out of the water for people on weekly pay, by the way. So bear that in mind, grain of salt, all that. As long as it's a 2-week pay period and it is not a month in which they receive 3 paychecks, then we would be able to take that year to date and subtract the current gross pay to get that year to date from the end of the previous month.
Right.
And
I'm
I think
okay with that piece. I'm just worried that we're going to have hundreds of applications coming in that the client has submitted their most recent pay stub, and they're going to expect us to process it by what was submitted. And that, quite honestly, is, I mean, that's where we try to hit the most accuracy as we can. We're always going to hit and miss something. But what I don't want to do is accept that pay stub knowing that we've got some November, quote unquote, November income. I don't know if you're looking at that recent pay stub as a current year to date, divide it by 11, multiply it by 3 and run with it, which is, from my standpoint, the cleanest. But I know that from my CDA standpoint, there's a whole different prospect that you're looking at.
Yeah. You know, I think that this is that you raise some really valid concerns, and I do also recognize that that these changes we're making, we're providing you guys with the training, and we are not providing applicants with the training. And so I am going to say that I think that this is worth having a larger discussion on, probably first within my team, to see where we can, because this is going to be a learning process for the applicants, and we don't want to put them out. We don't want to, especially since we're still in a pandemic and people have giant arrears on their bills. So I think that I personally am willing to go out on a limb and say that I'm willing to find a compromise on this. So like to have that conversation internally with my team first, but I would be very much interested in raising this to the rest of the network very soon, possibly during whenever we schedule our first regular listening session call for.
Okay, I can also offer, this is up to you, but I can add to my wage calculation page a line that will remove the current month wages. If they put in that or that current pay to remove that, that would only be helpful if they're paid biweekly and there's only 2 pays in the month. But it would be a step in removing that if that's what the true goal was.
Right. Yeah, that's a definite possibility. I'll have to look at those again. And I'll be the first to admit I haven't looked at them lately. But been a little bit busy with other things. Go figure. But yeah, let's set some time to work on these. So.
Okay, so Julie Wilson stated that it depends on when you apply in December, correct? Early in the month or at the end of the month? What is the threshold? That's correct, Julie. It does depend at this point when they apply. If they apply early in December, then you're going to want to get the last paycheck stub for the previous month, which would be November. Possibly later in the month, depending on if they're how many pays for a person that gets paid bi-weekly, depends on how many pays they have. If someone is towards the end of the month, say they apply on the 26th, it's quite possible that they've already received their last paycheck stub and turned that into you. So then you would be able to calculate using that last paycheck stub and count that for the month of November.
Hey, so real quick, this is Julie. And that was in context to Tom's example. And I was just confused because, and I can't exactly remember what the example stated now, but it was for someone who applied in December, but the example was saying, and it was about zero income and some other scenarios, that you would do something that didn't seem to me like we were considering December, but there was no threshold stated regarding December. So it's kind of just a thought I threw into the chat, and I'm still kind of overall confused right now, but I'm going to try to work through it and see if I can figure it out from there, all of it. Thank you.
So you got into a little bit of an explanation from Pam. Let's see, let me see the next. She stated that the threshold is expecting any more pay stubs in November. If they are, then you can't use any November pay stubs, have to use November. Then Amanda from Hoosier Uplands asked, are we to use the 3-month or the 13-week when calculating income from a check stub? That is,
Yeah.
Yeah, go ahead, Tom.
Sorry.
I got my question answered now. As everyone's been talking since then, I think it's been answered.
Okay.
Okay.
So Lisa Ritter-Scamp stated, so my concern is that the most recent pay stub isn't really what we need in many cases. It depends on the method that you use, actually. If you're using the 13-week method, then the most recent pay stub that was received in any situation, you should be able to use that. If you're using the 3 most complete months, then you would possibly need to request additional documentation. Julie asked, will the pilot program be ready to go in time when we are able to begin processing applications and entering them into EAP Connect on the 27th? And yes, the answer is that.
Yeah, so my goal now that training will be done tomorrow, my next goal is to get the state plan submitted by the end of this week, and then I'm going to be working mostly on tweaking that spreadsheet with a goal of hopefully having it done, at least for everyone's review, by Labor Day, and also getting the Spanish language and large print applications drafted.
Okay. So then Lisa Ritter-Scamp stated that she's concerned that if the calculation sheet is used and does the calculation for them, not everyone will be able to grasp the concept. Julie Wilson states that Section 3 of the IBAs never looked like this. Yes, that was a very simple, clean document that Tom showed you. And I can answer this for you. I've seen many different types, but the thing to remember for Section 3, that whatever they document in there is what you use to calculate. And it doesn't have to be multiplied by 3. You know, if they say they get $50, then they've received $50 in the last 3 months. I don't think it's necessary for you to backtrack and start asking additional questions just to get clarification. Because it does state that in the instructions that they are to document the last 3 months of income for that section.
And I do agree, Julie, that it is clunky.
It is.
I redesigned a lot of forms this year. I started to try to tackle that one, and I decided that I had redesigned enough for this year, and that would be a next year project.
Okay. Elaine, you already stated about the calculation sheet. Julie stated that EAP calculates child support being paid, and she said she might have missed this portion in the conversation. And it does, but I think if this was in context to the question prior, you know, that is usually documented within a check stub, but when you have someone that pays directly to the courts, there's could be a possibly quite a bit of calculation that goes into there. So Angela Spurgeon is asking, is it one way or the other? Meaning, do we have to commit to the 3 months or 13 weeks? Can we use whichever one makes the most sense according to the document provided?
I think that's a reasonable solution. I think as long as you are using the same method within a household, I think unless you have any objections to that, Renee, I think that's perfectly reasonable.
I do not have any objections as far as that's concerned. If the calculations fall into the 2 ways that you state that you would like for them to do it, then that's not a problem. You know, I could definitely see if you have if it's one of those months where you do have more than 2 payments for the biweekly income, I could definitely see you wanting to use the 13 weeks formula, because then that way you'd be able to use that most recent check stub that's turned in.
Yeah, I'm happy to grant that flexibility.
So Lisa, you stated that thousands of applications come in with the most recent pay stub. The solution to that may be that you guys decide you want to use the 13-week calculation. But I do understand the concern. Ingrid stated if we have the most recent stub, though, we can do the 13 weeks, correct? Yes. Regardless of when the month is submitted. Yes. Julie says, this feels like we are heading back to prior territory of income calculations, having too much ambiguity based on the guidance and therefore lots of potential income errors. Just my opinion, maybe I just need time to adjust. Thank you for your honesty. Pam stated, why would you want to do 13 weeks? It's even crazier. Well, 13 weeks is consistent with the unemployment. So that's not a new idea. What's wrong with doing it the way Elaine just said? It's the simplest, easiest way to do it. Most recent divided by the month received times 3. What is the concern? Oh, this is from Pam as well. So basically, I mean, I think that Tom kind of answered this in the presentation. Because if you are, say you receive a check stub from November the 7th and you're calculating that and you want to use the income from the November 7th to calculate for November, you still have a whole month of income that isn't included, and you're trying to say that that is equitable to someone, equitable to calculating a 3 complete months. Also, if you are taking that and you receive an application on the 3rd, the person doesn't get paid until the 11th, then you're saying that for the month of November, that person didn't receive any income, which in our reality, that's not true. So it just helps strengthen being able to be consistent and have the same type of calculations across the network. Lisa stated that these types of changes need to be done earlier so we have time to prepare proper training for staff. I know you all are very busy, but this is really hard on all of us too. We have lots of administrative items that need taken care of too, not to mention how hard it is to hire right now.
I hear that concern. I do hear that, and I acknowledge it. You know, it's very, very valid. I wish I had a response to that right now. And I just, you know, I'm being very honest and transparent here. I don't have a good response to that right now. You know, I really am trying to make things easier for intake and applicants, and I realize that sometimes what's required in order to achieve that might actually make things more difficult for managers and trainers. And I don't, like I said, I don't have a response. I don't have a defense, but I do want to acknowledge that that's extremely valid, and I am hearing you, and it's something that in future years I can try to see if we can get this training pushed forward. I'd like to get back into July as it used to be. As you know, we've had a couple of really crazy years this year, especially with trying to coordinate this CARES Act batch. But this is unfortunately where we are right now. But heard, feedback received, and we'll definitely try to take management into account with the burden reduction in addition to the applicants and intake.
Mary stated that they have some in their area that are paid weekly. Not sure how that translates to this way of doing things. Honestly, Mary, if you have individuals that are paid weekly, the 13-week process may be easier for you. Lisa stated we have several that are going to daily pay and the stubs do not show year to date.
Lisa, you just made my brain hurt.
My
daily
suggestion,
pay?
Yeah, I don't. I would suggest the possibilities. Honestly, you may need to send a letter to the employer if they're not able to provide year to date.
I'm actually curious to know whether that's a Fair Labor Standards Act requirement, though, because I know providing pay stub information is an FLSA requirement, I believe. I wonder if they're actually skirting some of those requirements. It's neither here nor there, but.
Just to ask, is the list of documents that should be submitted that was created by HCDA located within the appendice forms? Oh, this going to be corrected regarding the most recent pay stub. It isn't the most recent pay stub that is needed in all cases.
Good point, Justa. I will update that. Making a note now.
Yep. Lori Dunwoody is stating that if you have a person who gets 24 pay stubs in a year, then to be equitable, you would need to use 12 weeks of income. Angela stated that she just wanted to verify, is there going to be a calculation sheet that is going to help calculate the 13 weeks? Yes. My other question is, if we do the 3 months and we receive a paycheck at the beginning of the month, can we subtract the paycheck's gross wage for that week's pay to get the year-to-date for the prior week's check and make sure we make notes in the system? Absolutely. Elaine states there's a spreadsheet for that. Angela said, thank goodness. Angela Lambert is saying around here, temp agencies do not show the year-to-date. Lisa states the same thing. So that's it for what we have in the chat. I know a few hands came up and then went back down during the time of trying to go through that and get to the end. Are there any questions that wasn't answered that you would like to ask regarding it? Thanks, Elaine. I only do what Tom tells me to do. Just remember that. Only what Tom says is what Renee does.
Oh, there's that bus.
Okay, so Pam said 13-week unemployment is easy and sensible. We can actually see the last 13 weeks received. We are still guessing at the last 13 weeks based on the last check stub received. It's no different than taking most recent check stub, dividing by month and received and multiply by 3. Duly noted, Pam.
Mm-hmm.
Are there any other questions?
I have rejoined the chat to answer any questions that may have been lingering from earlier today. You all seem to be well informed and ready to go, but so if you don't have any questions, I will not be offended. I think Elaine's giving me that look, Thomas.
So Dave,
Julie both. I think Julie give me that look too.
So to clarify, Dave, we actually, so I knew that income calculation was gonna have a lot of questions. So I actually built I actually structured the income calculation to have its own kind of informal Q&A period at the end before the formal Q&A for the entire day began. So we're kind of at the tail end of that right now.
Oh, okay. So I can just relax?
Yeah, you can relax for now. Just until we get through the through the income calculation discussion at formally, and then I'll kind of open up for all other questions.
Sure.
So Pam, in regards to this last comment, you said in last comments about daily pay are not helpful. We need to keep up with the current reality. I do understand where you're coming from, but if you remember, it was stated that you have, there are ulterior ways that you can get documentation. So if you send the documentation to the employer and the employer does not fill that document out, then the applicant is allowed to do the IVA, but you have to prove that you attempted to do other steps first. Your IVA shouldn't be the first thing that you do. And that's just because it's very easy to fill out an IVA and say, oh, I got $500 in the last 3 months, when in our reality, it could be something different. So you need to do your due diligence to get that information. If the employer refuses to fill it out, then the only option you have is to have that IVA completed. So, I mean, there is a solution. I do understand that it gets difficult when you have those situations that you don't normally run into. But at this point, until we have the discussion that Tom was talking about, that may be the only solution at this point. Hannah says she just wanted to clarify, are we supposed to be looking at the app signature date at all when calculating income, or based on or only calculating income based on the date app was received by the agency? So for example, someone signs an app February 2nd, but we don't receive it until March 14th. Do we use the March 14th date or the February 2nd dates based on 13 weeks of income?
March 14th. So it's when the application is actually received. I have absolutely seen applications before that were signed by the applicant in November and then not turned in until April. So yeah, it's whenever you receive the application.
Rosa said that since we are not to use wages from DWD inquiry and the inquiry shows the wages were reported in the prior quarter in which there are months we need to calculate income, do we request income documentation from the client? In that term, if they have not turned in that documentation, yes, you do. And then if the client does not return the income documentation that you need, then you follow your process on denying the application. You're welcome. Sarah has her hand up. You can go ahead, Sarah.
Yes, I have a question about what you just said about the signature dates and income calculation. Because previously I was under the impression that the signature date on the application was the date we went by to get the income gathered. But you just said it was the date we receive it, not the date it's signed. That's very confusing.
Yeah, it's the application date is always when you received. So it's when you receive the signed application. It doesn't matter when the applicant actually signs it. Again, I've definitely seen cases where someone signs it when they get the application and they sit on it for months before they turn it in. So as far as what you count as the application date, the best you can do is when it's actually in the hands of someone at the agency. That's always going to be your application date, and that's going to be the date you use to determine that eligibility period.
Can I ask when this changed? Because even as of last year, we were using the signature date, and we even had audit findings that corroborated that. Because we had a finding on our audit that said it was outside of the signature date. It should have been inside the signature date. And so we've always gone on the signature date of the application packet.
This has been the policy for as long as I can remember. If you have any of those examples handy, if you can forward those to me directly, I can take a look at them. But yeah, our policy for quite some time has been that the application date is when the application is actually received by the agency.
Elaine states we will never be able to spot on did even when calculating income, but I do feel dividing by the number of months and taking 3 months is as equitable as defining the 13 weeks estimated similarly. Just throwing it out there.
Yeah, I can see that, Elaine. My whole thing, the 13 weeks where that came from, it was a perceived disparity that I'm trying to address, just in terms of the whole unemployment. I'm trying to make sure that things read with the same definitions, and with the 13 weeks, that kind of also grew out of the development of this spreadsheet to completely automate the calculation. So just to be clear, that's kind of, I definitely, as you can see in the policy, I mean, 13 weeks does equal 3 months. It is exactly the same. Basically, we just have the two different methods. But I'm not necessarily advocating for one over the other. My stance is, my stance is actually what you're saying, that it is equitable and that we're estimating similarly. And basically by doing one or the other, from my point of view, we're actually giving some flexibility there. And again, trying to actually automate and remove even more opportunity for human error and having to do math.
Angela has a question. Do you have a question still, Angela?
I just wanted to ask to go back on where the date they signed, just to make sure we eliminate any confusion. Do you want us to make sure that we put a note in the system to say the client's date signed it at this date, but we received it at this date, so that we can eliminate any confusion?
You're able to document that by your date stamp.
Okay, I just didn't know if you wanted
When
us
I look at an
document it.
application, I know, well, for myself, when I look at an application, the date that you date stamp your application to me signifies that that's the date that you received the application. So I will look at that compared to what you have entered into the system.
Okay, just want to make sure. Thank you.
Sarah, did you have another question, or is that from previous? Okay. Brad asked, why can't we use the wages report on DWD if we have accurate quarters reported by their employer? See, that's the thing. A lot of times employers do not report accurately or timely. Sometimes some employers do not report until the end of the year. So that's
even
yeah.
Even at the best of times, pre-pandemic, you were routinely not seeing employers report until 2 months after the quarter has been over.
Right.
Our stance is that essentially, if you're actually pulling employment income from the quarters, from that quarterly data, first of all, if we're taking the most recent 3 complete months, you would have to hit it just right, and probably 9 times out of 10 at least, that information is actually not going to be timely.
Okay, so Rosa asks for unemployment benefits, if they were denied on the date first processed and then at a later date, then it was paid on a later date, are we to count that benefit if they are getting benefits for months that are passed out in the 3 months? So any income that is collected during the 3 months or the 13 weeks, as we would say for unemployment, if you have 5 payments that was received on the same date, you still are going to count those 5 payments no matter when those payments were originally submitted, because that's when the individual receives the income. Okay, so this is last call for Okay, Justice said, regarding to the earning request form, on top of everything that is expected of intake staff, opinion, having them to reach out to the employer for income is taking a lot of time away from processing. A lot of time they don't have contact information for the employee. There is no time, as we are trying to get through applications. They could have multiple jobs that we would need to do this for. And in some cases, the employees won't complete or won't even return it. This is a lot of time being spent on something that we might not even get a result from, only to have the participant to go ahead and complete the income verification affidavit. Okay, so this is the thing, and I think the important part to remember of that is the attempt. If you are not getting the information that you need to be able to do that, then you know, by all means, they can complete the income verification affidavit. But if the client is being non-compliant about providing income documentation or even information for the employer, then we're talking about something different. Tom, do you agree with that?
Yeah, and you know, I want to be very clear also. I appreciate what you're saying, Justa, and I especially know the frustration, and I know it firsthand from when I was you know, at the LSP level, of employers who are completely non-responsive, and don't even necessarily take the time to respond with a denial to you. That's why when I was writing this out, I tried to be very intentional about being clear that as long as you document that the attempt was made, I'm not necessarily expecting intake or managers to, you know, follow up 5 times with the employer. The employer, you know, if we give them a notice, if we document that we sent this to them, we document that there was no response, no acknowledgement. I mean, we've done our part. We've done what we can do. I think that for the, you know, in order to show that we've done our due diligence, we do need to at least make that first attempt. And again, this is just about being good stewards of federal, you know, taxpayer funds. But we don't need to go overboard with it. You know, that's why I didn't even put any guidelines in there about how many attempts should be made. Just make an attempt, document it. You don't need to follow up multiple times. Does that help? Acknowledging that and letting you know that I'm not expecting a whole lot of follow up if there's no follow through, that you just need to document one attempt.
If you're trying to answer, Justa, you're still on mute.
Okay, so here's the other thing that I'm afraid of. So if we ask for this form and we try to get this information and we do one attempt, so we tell the participant, okay, we're going to attempt to get a hold of your employer and, you know, give them a day or two to respond. So then what happens when we turn around 2 days later, we haven't heard anything, we reach back out to the participant, and then communication is dead from the participant. So then we've missed out on that participant because they've moved on for other resources, or, you know, they've just moved on because they don't want to wait. So we've potentially lost that participant now because we've waited to hear back from an employer that chances are, you know, if they've left on a bad note, they know they're not going to get anything. So why they probably think, why should I waste my time if I know they're not going to respond?
Sure. Would it address that if you were to kind of take almost like a provisional IVA, and basically if you do hear back from the employer, you use that instead of the IVA, but if you don't hear back from the employer, you already have the IVA on hand and you can just use that document that in the file?
So that should work.
Cool. Yeah, I'm okay with that as a strategy. You know, as long as we do show that we also made the attempt to get independent verification, as independent as, you know, the employer's word for it is, but something that would in theory be verifiable if the federal government were to decide to follow up and try to verify.
Okay. So Christy Underhill says that she gets applications all the time, that turn them in months after they've signed the paperwork. DWD will not accept the DWD form signed over 60 days ago. She often has times to have to send out the new form. It's very time consuming. I do understand where you're coming from as far as that is concerned, but unfortunately, that's a DWD rule that we have absolutely no say-so over whatsoever. Brad, you have your hand up?
Yeah, I just want to clarify. I think you said if someone received DWD unemployment, let's say 18 vouchers in one day, which that should not happen because all of that's done and over with of them being behind. But you're saying if they received 18 vouchers on one payment date, we're counting those?
Yes, sir.
How are we going to determine that? Because there is not a payment date on the DWD report. The process date is the actual processed voucher by the claimant. That is not a payment date.
No, the process date is the date that it's processed by DWD.
Can you clarify that for us with DWD?
Yeah,
the only reason why I'm asking that, Renee, is I used to work for DWD in the unemployment office, and the process date is when they process their voucher.
We can certainly clarify this with
because they may have changed the wording after I left too. That's why I'm verifying.
Yeah, I can definitely reach out and clarify that because I already kind of made contact with them to get the updated form. So I'll just reach back out and just let them know we're updating our procedures and please provide guidance on this.
Because I'm basically teaching my claimants to get me the claimant detail of each week for 13 weeks because this DWD Inquiry report is totally messed up anyway. Like you said, sometimes the wages are not reported correctly or on time. Sometimes they are. And also the federal stimulus, which is supposed to be ending here in a couple of weeks, September 4th, has not been on the report as well. So that's just
been a mess.
My question. Thank you.
Yeah, thank you.
All right. Samantha Pence asked, in case like Christy stated, could we call the client to receive permission to fill out a new form and make those notes? Unfortunately, Samantha, no, really, you wouldn't be able to do that because DWD requires a signature by the client. You cannot state that you received permission over the phone. So it would need to be signed by the client. Rosa states that online applications, if we need to request additional documentation, are we still okay to send the message through EAP Connect? And if we have not heard from them, can we proceed with a denial or do letters need to get mailed too? No, you're not early on that process. It's okay for us to transition into other topics because we were supposed to start other topics on the half. So it is okay for you to use EAP Connect. The only thing is, and this is guidance that I have given before, is that if you use EAP Connect, you need to be very detailed in the information that you put into the system. I always encourage you to put a due date and things like that. Because I have seen some notes say that Social Security card is needed for Jane Doe, but there's no time frame of when to return the documentation and things like that. I do think that it is the best practice for you to do both, especially since EAP Connect is still really, really new. Because people don't check emails like they check their mailbox, sometimes vice versa, but it just depends on how you want your process to be. If you use EAP Connect, then you can use EAP Connect. But as long as you use the same timelines for for each application type, then I think that you'd be okay. Do you agree with that, Tom?
I do.
Are there any questions on anything that was previously discussed prior to income calculation? No policy questions?
Did we get Dave? Did we get Dave to get back on here for nothing?
No, I actually enjoy listening to the questions that are asked because it kind of gives me a little reference about, what things that are going on and all that too. So I like hearing these questions because the questions that are being asked are questions that are being asked to make sure that the process that everyone is using is the same process.
Mm-hmm.
And so I like listening to that kind of stuff. So it's not a problem, Thomas.
Excellent.
Plus, I think you need some help when Elaine tries to come after you. So
Bad Elaine. Well, I'll give it another couple minutes, but if no one has, oh, I see Angela just came in with another question. Manual states 14-day denial on incomplete apps. Can someone tell me how this looks? I've always used a 55-day deadline as a denial date for incomplete. It makes it easier to track our incompletes. Yeah, so Angela, I am happy to let you know that actually our incomplete letter template is changing within EAP Connect. It's actually going to have, not only is it going to have a 14-day return date on it, but it does actually, it should be calculating what that deadline would look like. It should, based on the date the letter was sent, and it would have it would calculate 14 days out from that date. With the idea being that by having the applicants return them by that date within 14 days, it will make sure that because the 55-day approval or denial is based on the date of application, not the date that the application was completed. So if you're actually giving people the full 55 days, then that means that if they return with that application, with that information, you would need, like if they wait until that 55th day, you would actually need to process, determine eligibility, and notify them on that very same day. You would have absolutely zero wiggle room. So what we're doing now is we're going to do that soft denial at 14 days. And then the soft denial letter, the denial for incomplete application actually is also going to be changing slightly. And I haven't looked at the updated notification letter that I drafted in quite some time, but I want to say it gives them 30 days to return that information. And again, instead of just saying 30 days, it actually says your deadline to return this will be, November. I know that's really early considering November 1st is the start of statewide application opening, but like, November 5th or whatever. It'll give them the date. And that actually hopefully should make it really easy for intake if they receive it to say this is in date or this is out of date.
Okay.
Sorry, I see there's a lot more conversation going on now.
Yeah. So Angela she said, so Justin, I'm not skipping your questions. I'm sorry. This is in context of what we're discussing right now. So Angela says, so are agencies entering every app at the time of receipt? And I think that's what Angela, are you saying that the 14 days is from the date of?
So just to clarify, so if I receive an app like today, I'm going to have to enter it into EAP Connect to then generate that incomplete letter, correct? I mean, is that how agencies are doing it? Because like currently we just put them in the file, but if they're incomplete, we send out just a handwritten, hey, this is incomplete. We give them however many days. I mean, we typically, like I said, just do the 55. So then on that 55th day, we do pull those every single 55th day, and I deny those that day. So they do receive priority over the others. We don't miss those dates. But so now, I mean, we're gonna have to kind of change our process. I'm just curious, when people are getting an online app, are they instantly processing that? I mean, you know, because some days we get 10, some days we get 50 online. Do you process all 50 of those that day? I mean, how does that look for other agencies with that 14-day deadline now?
Yeah, I can't really speak for other agencies' processes, so I'll kind of like open that up for discussion if that is helpful. I do want to point out, I do see in the chat, Elaine is speaking to something that definitely was my experience when I was at SCAP, that denials stimulate many to submit documents quicker. I've definitely seen that, where I could send incomplete letter after incomplete letter after incomplete letter and no one would return anything. All of a sudden I send them something saying they're denied because they didn't submit their income calculation, their income documentation. Let me tell you, 2 days later, I have them in my office trying to hand me the income documentation. So I do think that tightening up that time frame might actually kind of counterintuitively actually increase your receipt of the information that you're looking for. But I'll let others kind of speak to their experience as well.
I think we're mixing the two deadlines. We have 55 days in which to process an application upon receiving that application. Once we get to, so say we don't get to it until the 20th day, we realize that that application is incomplete. We send out an incomplete letter that gives the individual 14 days in which to send the information back. I think that's what we're talking about. I'm wondering if we have the two deadlines commingled.
So I don't want to speak for Angela here, but I think it's kind of 6 to 1, half dozen of the other. So the way the policy was written before, yes, 55 days to determine eligibility from the day of application. But our policy on incomplete letters basically required that you gave applicants at least 2 weeks. It was written as 10 business days. So at least 2 weeks to return those documents, but we didn't necessarily put a firm cap on that. So some agencies would give it up to 55 days out from the date of application. And it sounds like that's what Angela's process was.
Got it.
Is that accurate, Angela?
Yes, yeah. So I used both, really. I mean, when we got the application and we gave them 55 days, we check every application at receipt. So occasionally one would get passed that we would maybe not ask for something that we needed, but 99% of the time when it got to the desk to be processed, everything was there. And luckily we don't get too far out on maxing that 55th day. So if it does get to somebody's desk and on the 45th day they don't have what they need, then we do reach out and go ahead and get the remaining stuff. So it's going to make me change my process a little bit this year if we have to stick hard and fast to that 14 days. And I'm a little concerned with trying to get them actually entered into EAP Connect to get a denial in the 14 days, because we get hundreds of incomplete applications. So that's really going to take priority over processing complete applications based on the time frame.
So yeah, and if I'm like hearing your concern correctly, I think that as far as, I mean, I am getting the template put into EAP Connect this year. If you have an established process that kind of handles this already, I think I am comfortable with, not necessarily requiring you to necessarily use the EAP Connect letter template every time. I think I'm comfortable with saying that if you have your policy and your procedure in place and it works for you, that you can use that. I think in terms of consistency, it probably does help to maybe tell them, in 14 days you're going to be denied. If you don't get that denial out in 14 days, I mean, as long as you get it out within 55 days, you're within the policy. But I think maybe telling them 14 days instead of, giving them that full 55 days might also light a fire a little bit. That might hopefully increase your return on those documents. So does that sound like a reasonable compromise?
I mean, it does. I'm open to looking at different options, but I noticed Lisa had commented and she said, don't we have to enter applications in order they are received? I agree with that. When we get a completed application, when we receive that final piece of paper, that's the date it goes in order to be processed. I'm not sure if that's what Lisa was trying to say or not, but we obviously, as we receive a completed application, we process them. So I'm just open to options as to how people have done it so that I can look at different ways or tweak what we're currently doing so that we meet policy.
Okay. Justa has a question that says, is there going to be a self-declaration of primary fuel source level from this year?
So that was something that, from what I saw anecdotally, it seemed like a lot of people were just kind of confirming that verbally, and just documenting it in the client file. And it seemed to me, especially with so many people doing it verbally, it seemed to me like it was just another piece of paper that we were having the applicant fill out and sign for no real good reason. And so what I wrote into the manual pretty much was, they can declare this verbally. If it's a matter of a prepaid electric source, you should be able to see from the account status report, they use this much per day, and they're going to be within 10 days of running out at that pace. It seemed like it was just an extra piece of paper and red tape that essentially I eliminated, trying to eliminate some of the paper that we're generating and making people sign and fill out. If that was vital to your processes, I can absolutely reintroduce it as an optional form. But I really have no interest in requiring an extra piece of paper for people to sign for no good reason.
She's also asked, is the referral form still required to be part of the packet?
Did that fall out of the manual? I thought I had that in the manual, because I would like to see that still, because it is kind of vital to the idea of trying to build up the idea of this being part of an overall picture of a self-sufficiency program rather than a transactional program. I know that a lot of our client base does see this as transactional, but we would really like to try to move away from that. And that was the purpose of rolling out those referral forms. And again, I am aware that does kind of fly in the face of what I just said as far as reducing paper. But I do see this as being a little bit more of a bigger picture thing. And I do still intend to have the whole out for it, where if you give it to someone and they don't return it, you're not going to have to follow up with them to get them to return it. You can just document it. It can be an application action, so you can just pull down to it real quick. But I would like to see those continue. and I'll double check the manual to make sure that it is in there.
Julie Wilson states that she likes the change on prepaid electric, that we can use client confirmation still, but also use the bill as verification of crisis. Thanks for that and for alleviating the self-declaration crisis form. So Justa stated that you mentioned earlier that you had created a page for participants to list additional members. We have a lot of households that have more than 5 people in the household.
Yeah, did that extra page not end up in the forms appendices I mailed out? If not, then I will find where that disappeared to, because that should have been in that folder, and I'll make sure I get that out to everyone. Yeah, I know that was one of the things that when we rolled out the draft, that was, I think, the #1 comment I had was that, you know, having only space for 4 household members on the form, and for all of the CSBG Module 4 reporting that we do collect to help the agencies with that report, I could find no other way to structure the form that collected the data and would allow for more than 4 people without shrinking it down even more absurdly small than it already was. I am open to revisiting that next year, but I think for this year, it kind of is what it is. And unfortunately, the larger print versions is going to be even worse. So prepare yourself for that.
This question kind of goes back to what we were previously discussing. Lisa Ritterskamp asked, must we send a denial if the incomplete letter stated that they will be denied if not received? Is that language part of the language that was changed on the incomplete, Tom, or?
We absolutely must send a denial, because the denial also is going to have, so the incomplete letter, I believe, is not going to have because it's not a final eligibility determination, it's not going to have the appeal information. And we are restructuring how the appeals are handled within EAP Connect. And even though we do tell them that you're going to be denied, I believe it is a federal requirement that we do give them a firm communication that you have been denied. I think that's hidden somewhere within the LIHEAP statute that we must explicitly notify them that they've been approved or denied.
Can you hear me, Thomas?
I can.
It doesn't say that anywhere in the manual, just so you know. I looked because I was trying to eliminate a step to save time, and I went looking for that wording specifically, and I do not see it in there. So I was considering not doing that to save money and time and postage, but you're saying that we still must send the denial letter.
Yeah, that's going to be a federal requirement, I'm afraid.
I will agree with you that when I do send denial letters, you're correct. I suddenly get documents. So that's how it works, but it is, just another thing. But okay, thank you.
Yeah, it's unfortunate that that's that way, but it's how it works.
Also, I had a question in the chat about, you were mentioning the self-declaration of primary fuel source level. Are you saying that is not a requirement anymore? We can just case note those
correct.
Things?
I have actually removed that form entirely. I did not issue that as part of the forms this year. But I know that if any agency, if that's a vital part of their process and they would like to see that continue, I'd be open to reissuing that. But it would not be a requirement.
It was mentioned in our audit, so I was going to add it this year, but I will not do that since it's been taken out. So thank you.
Absolutely.
So, quick question though, Tom, is the verbal confirmation required? And this is for my clarification.
So for the way the manual reads right now, the for any bulk fuel, biofuel, anything like that, the crisis is issued at the time of application in order to ensure a delivery of as large a delivery as possible and to cover those delivery fees. As far as actually marking the applicant household as being in crisis, that would be with a verbal confirmation, or if they mark themselves as being low or out of fuel on the application itself. So I did document in the manual a way that an applicant could actually not necessarily be in crisis and not declare themselves to be in crisis and still receive that crisis on bulk fuel in order to be able to get that large delivery. Also, what Julie was referring to is I did put language in there that if someone is on prepaid electric, and you have that current billing report and it shows that, say they're using $3 a day on average and they've got $20 in there, then you can reasonably say they're going to run out in less than 10 days. And you can just mark it as a crisis there and award that crisis at that time.
Okay. So there's a lot of back and forth about when applications are to be entered into the system. Some people are saying, so at least, let me see. Some people are saying that that they are entering it once it's completed, so the denial is considered a complete application. Oh, let me see. I'm trying to figure it out. Lisa's asking, so when do you enter the applications that never submitted their missing documents? And I think this is in response to when they're entering into the into EAP Connect. And I think that from what I got out of it, and Angela, you can absolutely correct me if I'm wrong, is that her process is to follow, if it hasn't been turned in within 55 days, then that's when it's going to be considered complete, because then it's denied at that point. And then that's when it's entered into the system. Is that correct, Angela?
Yes, that's what Lisa was asking, when we enter it. So yeah, I was just clarifying. We hold all those incompletes till that 55th day. We pull them on the 55th day, enter them into EAP Connect and deny them. Go ahead and mail them a new application. Of course, on the denial letter, we list all the things they didn't return. We send the new application, encourage them to reapply because now they're able to on that 56th day.
Right. And then Angela Lambert is saying that they enter all applications in the order received. If incomplete, then they get the incomplete letter with 14 days, which is correct. Should all apps be entered in order received or only when they're complete?
So the by the book manual answer to that, if I'm hearing the question correctly, is all applications should be entered into EAP Connect, whether they are complete or not, and that you are able to then run reports to see who's still incomplete. Is that always realistically feasible? Maybe not, depending on your agency. Different agencies of different sizes have different operations and different needs. The by the book answer is yes, they absolutely should all be entered regardless of whether they're complete or not. Do the best you can, which absolutely is how I lived my life when I was the EAP manager at SCAP. I'm not encouraging anyone, obviously, not to follow the policy as it's written. I'm just saying that we are aware that there are sometimes other circumstances that might prevent things from following the policy 100% the way it's written. Unofficial guidance, do the best you can.
I may reach out to Angela Lambert, just to have a conversation, just to see how that flows and how she tracks those incompletes then, and you know, if they're entering them every single one as they're received. I'm just curious how that looks and how it's tracked. So it's not something I'm opposed to doing. I just, in our situation, can't see how that would flow reasonably and us stay on top of everything and keep it all organized and where everything is. But I'm definitely open to hear how others do it. So I may reach out to Angela. Just FYI, Angela.
Tom, isn't there an enhancement that's being put into EAP Connect to where the LSPs would be able to pull a report showing applications that are incomplete?
Yeah, I'm pretty sure there is. I think there might be one now, application status report, although I know there was in RIA. I know that some of the RIA reports did not get ported over into EAP Connect, and we have requested that all of those reports get ported over. So if it's not there already, it should hopefully be there this year. Oh, and I'm seeing in the chat, Elaine and Angela are saying that yes, it's already there.
Okay. And then Ingrid is asking if the household has more than 4 household members, can they just add a page to the app and not use the additional form?
I need to look at that additional page again. I think just in terms of it having a legal signature on it and being consistent and getting all the right same information in the same format, I think it would be easier for intake, and potentially might be best for us in terms of auditing if they use the form, but I'll take a look at it again and I will advise you later that, Ingrid.
Julie Hardesty is asking, is there is the new IHCDA application checklist required, or can we still create our own?
So I think the way I have it, I think the checklist is part of the instructions, I believe, which I would like to see included with the application. But I want to stress that absolutely does not prevent any agency from creating their own cover sheet to accompany the application packet. Please, I think that actually will, kind of help with your client relations and with making sure that you're getting the information that you want and need to see from your clients. So I would like to see that instruction form accompany the application, especially because it's also going to include the federally mandated disclosures. But please, please, please feel free to also create your own cover sheet.
Justice states last season, once we had received missing documents for a 15-day, we had 10 days from the date the document was received to process. Is this still the case?
So you will have until 55 days from the application date. So it kind of depends on when you sent that incomplete letter and when you get the information back. If you get the information back, if you send it out right away and you get the information back and it's like been 24 days, you actually have like 31 days to get that done. So it's based on that 55 days from the application date.
Lisa Castle stated that it looks like I think this has to do with documents, or it says, no, it's not showing up to us as a reply. I think your comments just show up on the right, but not as a reply. So you are doing it right. I think that was in a reply to someone else.
I saw Ingrid say something about her comments are showing up as replies to someone, so it might be that.
Oh, okay. So all bulk fuel clients, this is from Julie Wilson. So all bulk fuel clients, propane wood, aren't expected to be processed within 48 hours if they are crisis files, unless they have indicated that they are in crisis. Is this correct?
Yeah, that's how I have it written this year. You know, I worked. So it was a concern that was first brought to me by Julie Hardesty, and I kind of talked to my team and came at kind of a compromise approach that would allow us to still be able to issue crisis to these bulk fuel people up front, while not overly burdening the intake of agencies that have some more rural counties with a large percentage of these bulk fuel and biofuel clients. I think with biofuel, especially with people who burn wood, you know, you might want to have a little bit extra consideration of verifying with them if they didn't check that they're in crisis to make sure that they've got enough wood to last them. You know, internally, you might still want to figure out a way of triaging those. But in terms of the crisis timelines and addressing those within the federally mandated timelines, I think it's reasonable not to expect everyone, especially, like I said, the agencies like LHDC, who have such a large proportion of bulk and biofuel. It's not necessarily feasible to address all those in 48 hours. And if they were to do so, it would be at the expense of everyone on metered utilities. So the workaround on that is if they don't disclose or state or affirm that they are in crisis, we don't necessarily have to count them as being in crisis. I hope that answered that question. Just trying to be thorough.
Rosa states that EAP Connect will show a red warning that crisis is given but not selected in the dwelling page. Will that be a change in EAP Connect?
Thanks for bringing that to our attention, Rosa. I will speak with Brad and I'll try to get that downgraded to a warning instead of an error.
I think it's important for you to include in your training if that they still need to be making sure that they are checking for all other types of crisis, that they're checking that the household is in crisis. And if that warning is there, you know, make sure that your staff is paying attention to that warning.
Yeah. Yeah, I actually have been working with Brad to remove some of the extraneous blue warnings that sometimes have popped up, because I know from experience how easy it is, because there are so many warnings that pop up for so many reasons, to kind of become complacent to those and just click on them mindlessly. So I'm trying to get those whittled down to where when a blue warning pops up, it actually means something, and to try to break that complacency of just clicking it away.
Laura Collins Dave Stewart says, thank you all for allowing to present. Have a great evening. So he's not even here any longer. Laura Collins stated, and this is along the lines of when entering the apps, that is entering them as they go along has allowed them to update status of the application when the clients call in. And then Lisa Castle states that they process in the order that they are received, incomplete and all. And then the rest of them were just the answers to when the whether they can signify if it's running incomplete report. So does anyone have any additional questions?
Well, we're only 15 now minutes over, so that's not so bad. This has been really good discussion. Sorry, Renee, were you saying something?
No, it wasn't me.
It was me,
okay.
Cindy. Hey, before you hang up, I was just thinking about, I cannot get the flush notification letters to print.
Yeah, I did send a ticket to Rowing about that.
Okay.
And I will be updating everyone. I think I had mentioned that in an email to the network from like Friday afternoon, maybe when I sent out the language for the other letters. But I will try to get an update on that for everyone, hopefully by tomorrow.
Okay.
But
now,
yeah.
do they have to go out like within the when that does get fixed? Do they have to go out like within the next couple of weeks? Because like right now we are in our mail out process.
Yeah, I mean the official policy is, I mean, the official policy is actually 55 days from application date. So it doesn't really apply to when a claim is entered. I would say whenever it makes sense for you. I mean, I know that things are crazy for everyone right now. We're in the middle of a lot of moving parts. This is something that we need to do. But I would also say that some of us are probably also involved in some more important things right now. So work it into your process when you can. But I mean, if you're in the middle of working out your trainings and your hiring, obviously that needs to be what takes precedence right now.
Yeah. Okay. That 4,000 something just scares me.
For sure, it's a lot. It's a lot of claims that we did at one time.
Yeah.
And I do want to assure everyone we're going to have full presentation on ARPA tomorrow. But I want to assure everyone that I am really trying my hardest to structure ARPA so that we can avoid this exact situation next year.
Okay. All right. Well, thank you. Thank you.
Absolutely. Yeah,
Can I
Julie,
just make
good.
one clarifying thing on the CARES Act, which is we have to make sure that we're staying within the federal fiscal year. So everything that we do with CARES Act has to happen by September 30th.
Specifically.
Oh,
okay. I see what you're saying as far as the notification letters being sent out.
yeah. So all the notification letters, any time on task, we can only bill for, or you can only claim against those CARES Act funds until September 30th. So don't wait too long. That's all. Thank you.
Thank you.
Julie states that we start at 10 sharp tomorrow, not 10:30. I think that's accurate. Rosa, do you have, Tom looks frozen. Are you frozen, Tom? I think he is. Rosa, do you have a question?
Yes, I do. Because of the high volume that we have, I have not started the transmittals for the CARES Act. I did send an email yesterday, I believe, in regards to my concern is that the transmittal, when I run it, it will time out and it will not create all the transmittals for all the clients. And since we have over 9,000, I don't want it to get stuck in the middle and I don't know where to begin. So one of my thoughts was to run transmittals per vendor individually, and in hopes that the bulk fuel that we have is not as large as our NIPSCO, so that it won't get stuck in the middle. I did reach out to Rowing, and what they said to me was to follow the process of their transmittal process that they have in EatConnect.
May I jump in?
That is definitely outside of my scope. Sure, Ingrid.
Okay, we had about 9,100 families that we served, and I just bravely ran the transmittal, and it did not actually time out.
Thanks, Ingrid. I'll try it. Now, did you do individually or all in one?
All in one. I had over 1,000 pages.
And did it break each transmittal individually like it did in the winter?
So for AEP and NIPSCO, I ended up with 29 transmittals for 20 some transmittals for AEP. So 23 for AEP and 29 for NIPSCO.
Okay.
Now the problem with on the NIPSCO end was her error report didn't show the clients on the individual transmittals. So I'm going to end up having to send her, once we make the corrections, basically send her new transmittal totals.
Oh.
Yeah. But I think that's the NIPSCO thing and not anything that we can fix.
Okay. Thank you.
Okay, we are now 21 minutes past when we were supposed to stop. So I think we're going to go ahead and end it for today. Like I stated, 10 o'clock sharp tomorrow is when we're going to be getting started. And that would be Brad with EAP Connect. So we are going to have another question answer session. So any questions that you come up with after we leave today, please note them and we'll try to get those answered on Tuesday next week. Everyone have a great day.
Hey, thanks everyone.
Thank you, everyone. Have a good day.
Bye.
Thank you. Bye.